Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, on today's show, we have Adam Gallus back with us, also known as Dividend Sensei on Seeking Alpha. Adam, thanks for joining us.
So happy to be back, Brian.
Well, we've had some really fun interviews recently. We did one on 3M. We did one on BIP. Both those were companies that strong, relatively conservative companies that are really looking at 12%, maybe 13%, maybe a little bit more annual growth per year when you include yield and appreciation, which is really just a pretty great number and make for great investments. And it raised the question that for me that led to some more conversation between you and I that led to this podcast. And the question basically was, if you, Dividend Sensei, could only have a 5-stock portfolio with retirement in view, what would those 5 stocks be and why? And so, Adam, I'd love to hear kind of where you're at on that, and would love for you to kick us off into that process.
Absolutely, Brian. So I get this question a lot. You know, investors want to know, what's like a perfect buy and hold forever kind of thing? Like, you know, Buffett says, hey, if you're not willing to own something for 10 years, you shouldn't own it for 10 minutes. And so, you know, if you just had to buy something and not look at it for the next decade, you know, something you can trust that much with your money, is like, you know, what would that qualify for that kind of buy and hold investment? So, you know, trying to pick 5, you know, I'm looking for certain qualifications. Obviously, yield is important because, you know, income investors, especially if you're already retired, you want to live off that. And, you know, something like the 4 or 5% rule. If you can manage to get a 4% yield and never have to sell anything, well, that's the American dream, because literally your comfortable and prosperous retirement is 100% independent of fickle stock markets, and you can literally sleep well at night, no matter what the economy or the market is doing. So yield is important, but at the same time, anything with an unsafe dividend is just not worth owning, because obviously that's what pays the bills. You know, one of my favorite sayings from a TV show called Dragon's Den is, you know, share price is vanity, cash flow is sanity. And so with cash flow, in this case, dividends paying our bills during retirement, that's absolutely got to be safe. So that means, you know, dividend that's well covered by cash flow, that is itself very stable, recession resistant, and balance sheets also got to be strong. And, you know, sometimes that obviously that'll depend on the industries, because some industries have higher leverage built into the business model. But I'm talking about, you know, safe in terms of relative to the industry. Another thing, of course, is management, because, hey, if you're going to be holding on for 10 plus years during retirement, you got to trust that management knows what it's doing. So it's got to be experienced. It's got to allocate your capital well. It's got to be able to grow for the long term. It's got to have that long-term view. It can't be obsessed with the next quarter or hitting this year's targets. You know, it's got to have a track record of delivering in all economic, industry, and interest rate environments. And finally, as you alluded to earlier, I mean, I'm all about the dividend growth. Yield is nice, but, you know, a growing dividend is wonderful, not just because, you know, keeping up with inflation is important so your standard of living doesn't fall during retirement, but if you can manage, say, a 4% yield, and your dividend is growing faster than inflation, and you're living on all that income plus, you know, supplemental from Social Security, it's growing faster than inflation. That means your standard of living is going up over time. And so while some people worry about, you know, retirement, like, oh, am I going to make it 25, 30, 35 years? Am I going to run out before I die and it ends? You know, the high yield dividend growth portfolio approach, you can basically never have to worry about running out. You'll just get richer over time, no matter how long you live. So that's basically the theory of what I was trying to do. Well, I mean, for my own portfolio, for my readers in general, that's the kind of companies I'm trying to cover. And for this podcast, especially when trying to point out these 5, you know, kind of perfect for retirement, buy and hold forever stocks.
Well, and let me make sure I got all 5 of those points clear. The first one is obviously just yield, something safe that's, you know, 4% or greater is kind of the ideal. And then the second point is a company that's stable and recession resistant. Third point, strong balance sheet relative to industry. Fourth point, management you trust, and you gave some different details what that can mean. And then the fifth point is a growing dividend. Was that the 5?
Yes. And
Perfect.
Part of the growing dividend is, basically this is what I call the growth runway. I need to be able to see that, is this a business that management can easily and efficiently allocate capital into and just keep growing year after year or even decade after decade?
Great. Let me see.
And I should point out that while the goal was to get, above 4%, not necessarily every stock on this list yields that much.
Sure, that's fair. Real quick question. A little bit more explanation on stable, recession resistant. Did you have any, and if that's too big of a discussion, we can shelve it. I want to be able to focus on the stocks, obviously, in the interview. But is there any elaboration you can share as far as what you consider to be stable and recession resistant, or how you find that, or what you're looking for?
So in general, 4 out of the 5 I have are just really highly defensive in terms of its long-term cash. All the cash flows under long-term contracts, and essentially there's no risk in terms of if the economy, is like what happens with the economy, with consumer spending. And in terms of like the only one that is technically cyclical, it's 50% of revenue is essentially from fast consumables, which creates, relatively, consistent cash flow and some of the least volatile cash flow in the entire industry.
I think I know which one that is, but I'm not going to say yet. I'm going to wait and hear from you. Awesome. Well, let's dive in. Let's hear your list.
Okay, so starting off the lowest yielder, it's a classic but a goodie, Dividend King, industrial legend 3M. You just can't go wrong with it. 2.7% yield is the lowest on our list, but as I pointed out, in our last interview, you got nearly 10% long-term dividend growth potential as far as the eye can see, because these guys have their hands in every major growth. Data center, electric cars, autonomous vehicles, healthcare, infrastructure in emerging markets. It's absolutely a thing of beauty. Just like 3M, nearly 60 years of continuous dividend increases. Literally, it's great. It would literally take another Great Depression to force them to just not increase the dividend in any given year. And even then, I'm not sure that would do it.
Right. Well, I remember, and again, we talked about 3M in our last interview, and you talked very highly about the management and their ability to allocate capital, which were two of the things that really stood out to me. And then in addition, how extremely diverse their product lines are. It was like 50, 60,000 products over all kinds of industries. And like you said, their hands are in almost every single major growth trend. Like you think 3M, you think, okay, boring, post-it note company type thing. But it's because on a consumer perspective, we just don't interact with a lot of their products. Well, that's not true. We don't interact with the trendy, exciting trend products that you're referring to.
Oh, absolutely. Like you said, they have over 60,000 products sold in over 200 countries. And that's, is like we are aware of the Post-it notes and maybe some of like the safety equipment and like the face masks. But these guys,
right.
They everything, food safety, insulation, electronics, tape, sealants, everything, for the oil industry, the automotive, the electronics, aerospace, construction. They got their hand in everything.
And so 3M, 2.7% yield, looking at 10% long-term dividend growth potential, which obviously is great. And if I remember correctly, you said basically on the average, obviously every year there's ups and downs, but if you look at over a period of like 10-year periods, their average return, appreciation plus yield is over 12%. I think it was 12.3%. Is that accurate, or somewhere around there?
No, it was about 12.2 over the last 30 years. And right now they're essentially on track, and even management's long-term guidance is basically, we'll be able to achieve 9 to 10% long-term earnings and free cash flow growth. So when management basically says it's kind of like, obviously you take it with a grain of salt, but these guys, their track record is that, management doesn't miss on guidance, not over the long term.
Right. Excellent. Well, and again, to your point, then they have an excellent track record with management. And so if management makes that point, then you have good reason to expect them to hit it, because that's been their history for a long, long time and one of their great strengths.
Yep.
Great. So is there anything else with 3M, or do you want to move on to the next?
Sure. We can move on to the next one. So I'm not sure like what order you want to go is in terms of yield or, projected total return potential, but hey, we'll just go. We can. I'm fine
either way. I mean, we could go. You said 3M was the lowest yielding. I mean, the overall return potential is what interests me the most, but it doesn't really matter to me. Okay.
So yeah, I guess the next lowest yielder, Next Era Energy Partners, ticker NEP. It just raised its distribution. They do it every quarter. And another 15% year over year increase. It yields 3.8%. And this is what's known as a yield co. It's basically a renewable energy utility. And it's one of the most exciting stocks I know of. And it's one that I'm going to actually spend personally the next few months building up a 10% position in. And, for me, it's going to take some time, and that's going to be a big position, but it's absolutely worth it. And it's just, it has everything an investor could want. It's got that generous yield, which is more than double the S&P's yield currently. But more importantly, the growth potential on this thing is just, it's absolutely amazing. And most importantly, of course, the safety. They just announced earnings today, and their cash flow payout ratio is rock bottom, 28%. It was amazing. 37% growth in their cash flow this quarter. And it's just, it's mind blowing.
Can you tell me, just in case everyone doesn't know, you said cash flow payout ratio is 28%. Can you explain what you mean by that?
Right. So obviously, this is a pass through, as many of the high yield stocks I cover are. So their cash flow is known as cash flow available for distribution, or CAFD. Basically, it's operating cash flow minus maintenance, CapEx. And what I love about them is they take it even more conservative. They take out all the interest costs on their project level debt. They take out their incentive distribution rights. So literally their CAFD is directly what is available to pay the distributions to unit holders.
Gotcha.
And so the beautiful thing about their cash flow is it is rock solid. The way this one works is they have a sponsor called Next Era Energy, which is America's largest renewable energy utility. It's their core business is actually Florida Power and Light. But then they have this giant, fast-growing renewable energy subsidiary called Next Era Energy Resources. And so what they do is they just build solar and wind projects at a furious pace. And then once they do, they go ahead and they get what's called a power purchase agreement with investment-grade utilities, generally for 20 to 25-year contracts, fixed rate, inflation adjusted. And then once they've got that in place, so you've got that rock solid cash flow, no matter what the economy is doing, that cash flow is coming in. Then they'll go ahead and they'll sell or drop it down to NEP. They then get that cash flow, and they then pass that on in terms of a very fast growing distribution, which is a tax deferred form of dividend. And the thing that's made them a Wall Street darling and their claim to fame is that they're guiding for 12 to 15% payout growth through the end of 2023. And and the thing is, they've been doing this for the last 2 years. They keep saying for the next 5 years, we're going to be growing 12 to 15%. And it's always at the high end. It's always 15% payout growth. And because their cash flow is growing quicker than their payout ratio keeps dropping. So in essence, it's almost guaranteed that you're going to have that 15% for at least the next 5 years. And it's probably going to be a lot longer. And the reason for that is the most exciting thing about these guys of all. So right now they've got, after they just completed a asset sale, which it was a thing of beauty itself. I mean, it was just so profitable. It's going to fuel some more growth. After that asset sale, they have 3.5 gigawatts of solar and wind projects. Now, right now, NextEra Energy, their sponsor, they have 20 gigawatts of capacity. They're working on another 7.4. So that's a 33% increase in capacity just by the end of 2020. And most excitingly of all, they say that by the end of 2020, they're going to have a backlog ready to go of another 40 gigawatts through 2025.
Okay. So right now they have 3.5 gigawatts of solar and wind projects in process. They currently have capacity of 20. They're working on 7 more. And then what was that? Okay, take me again from there.
Right. So it's not, in the industry, it's called a shadow backlog. It means that, the 7.4 gigawatts that they're working on now, they have contracts already signed with utilities. So that's guaranteed. There's no risk involved. So what they have now is 28 gigawatts in what's known as the shadow backlog.
28?
Yeah, so it's 28 now, and they're saying that by 2020, that's going to go up to 40. And so basically they're saying we have interest from utilities. We haven't signed the contracts yet, those 20-year contracts, but we're confident that by 2020, we'll have 40 gigawatts more of renewable energy projects with 20-year contracts signed, ready to go. All we got to do is build it, and the cash flow is going to come pouring in.
So that's 40 additional, not 40 total.
Oh, yes. They're going to have
Good
40
grief.
between 2020 and 2025. They're going to build another 40. Between now and 2020, they're going to build another 7.4.
Gotcha.
And 3.5 is what NextEra Energy Partners owns today. So you add that all up, and basically by the end of 2025, they have the potential to go from 3.5 to 51, which is a 13-fold increase in capacity and cash.
Okay, so today they have 3.5 gigawatts. But they have 20. No, they basically have about 28 guaranteed between now and 2020. Basically, they have 20. They have contract, but they have contract. Basically, they have contracts for 28 more.
Well, no. So it's NextEra. Their sponsor owns the 20. Essentially, the utility that serves as their sponsor and general partner is the one that's selling to them. Right. Has this giant backlog of projects they already own, and they're okay with it because they have the cash flow coming in, so they're fine, and they're just saying, hey, as quickly as we can sell these to you, we'll go ahead and do that. And so NextEra is furiously buying these things, and their cash flow is growing generally 30 to 40%, per year. And the beautiful way that they do it is one of the concerns people have is with yieldcos of MLPs, any kind of these pass-throughs, is what happens if there's a correction or a bear market. Interest rates are rising. If the price is too low, you can't raise enough equity growth capital. So they've found a workaround that's essentially a self-funding business model. So what they do is they use what's known as self-amortizing non-recourse loans at the project level. So basically, they'll lever up each $1 in equity, in this case, retained cash flow, because their payout ratio is so low. And they'll borrow $4.50 to buy that project. The interest and the loan itself is all guaranteed to be paid off by the time that contract expires. And if anything were to go wrong, let's say, I don't know, it's just like terrorists attack the project and it goes offline and the cash flow can't service it. Lenders can only go, basically, essentially, it's like a mortgage. You can foreclose on that project and that's it. It's done. You can't go after any piece, the rest of its cash flow. So in essence, they build a nice safety moat around the distribution. And so by doing this, the beauty of it is they have so much retained cash flow that they don't need to issue pretty much any equity. And management has said, we don't really plan to issue much, if any, equity through at least 2020. because we just don't need to. We can use this self-amortizing project level debt to essentially buy up all these projects. And so that's the thing, is that they have no dependency on equity markets pretty much at all to execute on their growth projects. Their growth potential just keeps growing faster and faster because NextEra Energy, their sponsor and the utility behind them, they just keep building it so fast. And so essentially it's almost like these guys have for at least the next 10 years, they can grow their cash flow at 30 to 40% a year. And meanwhile, they keep retaining more and more because they're only growing the distribution at 15. And so over time, that fast growing payout keeps getting safer and the business model keeps getting stronger.
That sounds like a company that qualifies well for the list. And at risk of being annoying a little bit, I got really confused with the gigawatt stuff. And I don't want to focus on that too much, but just because I don't want our audience to be confused on it either. So right, and I'm going to read what I've written down, and you can tell me if I'm completely off base. Right now, NEP has 3.5 gigawatts of solar and wind projects today.
Yes.
And then then you said between 2020 and 2040, they'll have 40 more. But I got confused about between now and like 2020. You said because you also said they have 20 gigawatts of capacity and working on 7.4 more. I guess I misunderstood what you meant by that.
So their sponsor, NextEra Energy.
Sponsor does. Okay.
Yeah. The utility has 20, is building 7.4 more. And then between 2020 and 2025 expects that they'll build another 40.
Gotcha. Okay. So all those were on the part of the parent. And so, but then the thing is, as soon as NEP can, they'll buy those from them and move them all down. So that's good news. Basically, that's good news because NEP just keep benefiting from as the parent gets more projects, NEP gets more projects is basically the idea.
Absolutely. They just keep buying that cash flow. And it's so in essence, I like to joke that it's, they keep saying it's 12 to 15 through 2023, but the way it's going and the way the industry is going in terms of U.S. solar capacity and how quickly it's expanding, just to give you some context, NextEra is planning to essentially expand U.S. solar capacity by about 43% by 2025 compared to 2017 levels, all on its own. One company, and all of that is eventually going to end up owned by NEP, and with all that steady cash flow. And so it's like 15%, payout growth for the next decade at least. But really, it's as far as the eye can see.
So growing U.S. solar capacity by over 40% by what was the year?
By 2025, this one company alone.
That's incredible. Well, for sake of time, we could do a whole interview on that one, and we probably will at some point. Let's jump over. We've done 3M, NextEra Energy Partners. Who's next?
So BIP is the next lowest yielding, 4.7%. Oh, I mean, we've already been through it, so I'll just hit the high points. It's a rock solid. They have 95% of their cash flow is from long-term contracts or regulated industry. These guys own close to over 3 dozen assets in over a dozen countries on 5 different continents. Payout ratio is 65%. And that cash flow is absolutely rock solid, long-term contracted, inflation adjusted, volume protected. Their guidance is now, so these guys are managed by Brookfield, and I love Brookfield, one of the best asset managers in the world. I call them the Berkshire of infrastructure because they've literally 115 years they've been doing it, 285 billion assets under management, operating in over 30 countries around the globe. They're the absolute best at what they do. So these guys, they manage BIP, and they just keep finding these great deals for them to buy. And so like an MLP or like a yield code, Brookfield, they raise equity and debt capital from outside investors. They buy these highly profitable projects. Usually the cash flow yield on them is about 15%. And then they use that to pay a fast growing distribution. Now, they've been around for 10 years. over that time, they've grown the distribution at an average rate of 11% a year over that time. Now, management, they're always very conservative. They say, hey, 5 to 9% is our long-term growth goal in terms of the payout, but that's always based on organic growth. And so basically that means they're saying, hey, with just the projects that we have that we can build on our own, expand what we have, plus the inflation adjustment and cost savings from increased economies of scale, we can grow our cash flow 7 to 9% on our own and grow basically the payout at 5 to 9. And that's assuming no acquisitions. But of course, their claim to fame is they're always finding great deals and they're constantly executing on that. And so, you throw that in those acquisitions, and it's no surprise the analysts are saying, yeah, we think over the next 10 years, they're going to hit 9% average payout growth, which is the high end of management's guidance. And the thing with Brookfield is everything, all the LPs they run, whether it's BIP or the next one we'll talk about, BEP, is always 12 to 15% long-term total return is the goal for our investors. And these guys are very good. They over the long term, they pretty much always hit their targets.
So is that expecting overall, including appreciation and yield, growth of about 12 to 15% going forward?
Yes, and it's towards the higher end. For BIP, right now it's about 14%.
Wow, that's amazing. Well, again, tons to say about BIP. We did an interview on them not too long ago, so let's keep moving forward for time too. So you said the next one was?
Yeah, we can go. The next one's another Brookfield LP. It's Brookfield Renewable Partners, BEP. They're basically like BIP, except they focus just on renewable energy. So hydropower, wind power, solar power, plus some storage. So, essentially energy storage tied to wind and solar projects. And they yield a nice fat 6.4%. Now, their payout ratio is 79%. Management wants to take that to a long-term goal of 70% so they can retain 30% of the cash flow to invest in their organic growth projects, of which they have a ton. So BEP, they own 16 gigawatts of renewable energy right now. About 80% of that is hydropower across 81 rivers around the world. And they're expanding quickly into wind and solar as well. And their organic backlog of projects that they just plan to build on their own is 8 gigawatts. So that's basically over the next 3 to 5 years, they're going to grow their capacity by 50% and thus their cash flow by 50%. And that's assuming no acquisitions at all. But like everything associated with Brookfield, they're huge into acquisitions. And just, to give you the most recent example, in 2015, late 2015 and 2016, when we had a correction, interest rates were rising, yield curves as an industry went into a correction. A yield co called Terraform Power and Terraform Global, which were sponsored by SunEdison, they got into trouble and they basically went bankrupt because SunEdison mismanaged them, loaded up with too much debt, overcharged them for projects, just basically ran them into the ground. So Brookfield, as they want to do, they swoop in, buy up high quality, cash flow rich, wide moat distressed assets for a song. And so they bought 51% of Terraform, 100% of Terraform Global, which gave them about 1 gigawatt of solar and wind projects in 13 different countries, including fast growing markets like China and India. And they basically took over as sponsor for Terraform. And they recently orchestrated another major $650 million purchase for Terraform to basically take a big stake, buy out another yieldco in Europe called Sarda Yield. And so they keep expanding their assets globally. And BEP, essentially, their job is right now they own 30% of Terraform, and they manage it for Brookfield. And so now basically they got the cash flow from those assets flowing to them. They're also over time buying the Terraform Global assets, which is helping to grow their cash flow about 17% a year. And in the meantime, you've got those 8 gigawatts of projects that they can build out as well. And the great thing about them is just like NEP, they use project level non-recourse and self-amortizing debt, which makes up about 80% of their balance sheet. And because they're the biggest and oldest yield co and the most proven, they also have the strongest credit rating, BBB plus. So, I mean, they got a rock solid balance sheet. Credit markets love them, willing to lend to them at, nice low 4.5%. And so with all these growth industries that are so capital intensive, infrastructure, renewable energy, midstream MLPs, and so on, you need really strong access to capital. And so Brookfield, because they're the world's biggest infrastructure managers, they can line up the financing left, right, and center, really attractive terms. And so that's the beautiful thing about it. And just like with BIP, management is guiding 5 to 9%. And just like with BIP, analysts are saying, yeah, it's going to be closer to 9%, the higher end of that.
And so that's 5 to 9%, like total yield, like appreciation and dividend.
Oh no, that's just the growth. That's the growth.
Okay.
That's just the payout growth of 5 to 9. And with their fatter yield of 6.4 BEP, you're looking at a very conservative estimate of 15% long-term total returns, which is 1% more than BIP. And so it's just like, what's not to love?
That's pretty amazing. So just to recap real quick with 3M looking at around 12% annual growth ongoing, including yield and appreciation. For NEP, looking at around
19%.
Oh, I see. I missed that. Wow. Okay.
Yeah, that 15% growth plus a close to 4% yield. So
annual growth of 19% for any. Wow. And then for BIP, looking at around 12 to 15% growth going forward. BEP, 14. Okay, 12 to 14. BEP looking at around 15% long-term growth going forward.
Oh no, I should clarify. So BIP and BEP are both 12 to 15 according to management, but what they're likely to hit is 14 BIP and 15 BEP. Gotcha.
Okay. Perfect. And then bringing us in on the number 5 in the backstretch. What do you got for number 5?
Oh, it's the champion.
I love your enthusiasm. It's so fun.
It's the champion of midstream, what I call the Berkshire of North American midstream, Enbridge Inc. ENB. It's
ENB.
Okay. Yeah, absolutely. It's another one of those Canadian asset managers that's just the best in the world at what they do. These guys own North America's largest transportation system for oil, gas, natural gas liquids. They also own some regulated natural gas and electric utilities. They have renewable energy projects in Europe, which they're building as fast as they possibly can. It's literally a global energy company.
I'm taking notes. Okay, great. Okay, so the Berkshire Midstream, they own North America's largest distribution system for energy resources like oil, natural gas, and so forth.
Absolutely, yep. And 99% of their cash flow, long-term contracts, usually 15 to 20 year, inflation linked, literally take or pay, meaning that there's no volume linked. I mean, they're basically contracting with mostly utilities and large investment grade energy companies that they get paid no matter what happens. If there's another oil crash and the oil company stops producing, Enbridge is still getting paid what they're owed based on that contract. So they have almost no commodity sensitivity, less than 1% sensitivity to their cash flow from energy prices. 99% of cash flow under those kind of safe take or pay contracts. Their balance sheet credit rating is BBB plus, tied with Enterprise and Magellan for the highest in the industry. They're about to get a credit upgrade after their merger with its MLPs closes. Their payout 6%, nice and fat. 65% payout ratio, and they plan to take that down to about 55% over time. And they can absolutely do it. They got $17 billion in growth projects. They've got all the financing already taken care of, lined up for that. Those $17 billion will be completed by 2020. And then the best thing about them of all is that even though they're planning to grow the dividend at 10% at the end of 2018, 2019, and 2020, which, by the way, that'll be 25 straight years of dividend growth, making them the industry's first dividend aristocrat. At that point, they'll still be retaining between $5 and $5.5 billion in cash flow after paying their dividend. So that means that their shadow backlog, which is the projects they're going to be building after 2020, between 2020 and 2025, which, by the way, is potentially up to $30 billion in size.
Wow.
They're going to have that potential $30 billion growth project, 25 to 27.5 billion of which they would be able to fund with retained cash flow. And so essentially, they're going to be 100% self-funding business model, no reliance on equity markets. Their share price could drop to $1 and it wouldn't affect their ability to grow, wouldn't affect the safety of the dividend or the ability of the dividend to grow. And so, over 23 years, they've grown that dividend at 11% on average. You got 10% through 2020. And now beyond that, of course, it's probably going to slow down, but they should still, with the growth potential that they've got of that $30 billion growth backlog, it should still be able to grow around 8% for the next 10 years and possibly beyond, because America's energy boom, believe it or not, is expected to last to at least 2040 to 2050. And industry analysts are saying that by 2040, we're going to need to build over the next 22 years about $800 billion of new midstream infrastructure.
Wow.
So that, even though they're working on potentially $47 billion through 2025, that's still a drop in the bucket. They've still got a 10, 20 year long growth runway that they're going to be able to be growing that dividend at, potentially 8 to 10% a year on top of that 6% yield. So I'm being more conservative. I'm saying that over the next 10 years, I'm expecting 8%, but that's still 14% total return you're expecting.
That's what will give me the next question. 14%. And just with all of these, before we wrap up here in just a minute, all these expected returns annual, like I said, NEB is around 14% per year. That's including the yield and capital appreciation. And we talked about the yields. There's a lot of consistency there and ways to determine that. And if this may be way too much for this brief interview, but as far as the capital appreciation piece, how are you coming up with that number each time? Are you basing it on something specific, or analyst expectations, or historical numbers?
You mean the growth?
How are you getting at that total growth? Like, for example, NEB expect a 14% total return.
Oh no, ENB.
ENB. I'm sorry, ENB. Yeah, I'm sorry, that was my fault.
Yeah, so I'm actually using what's known as the Gordon Dividend Growth Model. It's what Brookfield uses themselves for all of their LPs. And it basically it's based on research since the 50s, which basically says that if your stock starts out at fair value and your payout ratio remains constant, then total returns have to equal, or it will generally equal yield plus long-term dividend growth, because over time valuations will cancel out and basically not affect the price. And so the dividend is going to grow in as fast as earnings and cash flow. And since stock prices are ultimately a multiple of earnings and cash flow, if you're growing at cash flow at 10%, the share price is going to grow at 10%.
Gotcha. So that's why you talked about cash flow growth so much, because it directly corresponds to stock appreciation based upon the Gordon dividend growth model, which is also used by Brookfield, which is a nice tip of the hat there. So, but briefly, the Gordon dividend growth model says stocks start at fair value, payout ratio remains constant, and the dividend will grow as fast as earnings and cash flow. Is that what you said?
Absolutely. So it's basically total returns are just a function of your current yield and plus the growth rate of the cash flow, which is equal to the growth rate of the dividend.
Okay.
And just to let you know, so this portfolio, if you equally weight all 5 stocks, it yields 4.7%, has a cash flow payout ratio of 59%, expected dividend growth of...
Wait. Okay, start that over. The average dividend is...
4.7.
Okay.
Cash flow payout ratio is a safe 59%. Okay. The expected long-term dividend growth, so at least over the next 10 years, but probably longer, 10%. Well, 10.1 actually. And so the total expected return for this portfolio would be 14.8. So basically quadruples your money over the next decade. And
total expected return of 14.8?
Exactly, 14.8. So about 15%, which is a good enough to quadruple your investment over the next decade. And to give you some context, John Bogle, founder of Vanguard, says that from today's stock market valuations, he expects the S&P to have a total return over the next decade of about 4%. The Gordon dividend growth model is more optimistic, says 8%. But either way, 15% is almost double that high, the high end of that guidance, and probably about 2.5% of the 6% that the market's likely to do from today's valuations.
A 14.8% expected return for the next 10 years is, that's legendary status. I mean, if you're an asset manager and you get that for your clients, you're legendary. That's an incredible thing. Because I've done that a lot with playing around with the retirement calculators and stuff, and talked to my audience about that a lot. Just a change in 1% annual returns for a period of time has a tremendous impact in the long run, and that's and you're talking about multiple percentage points here, which is pretty powerful. Man, Adam, as always, you do not disappoint. This has been fantastic. The only thing about this that I didn't like is that I'd love to go deeper because we need more time, but that's not your fault. That's mine. But hey, thanks so much for doing the extra due diligence to put this list together. I know it's giving me a lot to think about and a lot to process, and it will our listeners as well. And I look forward to doing it again soon.
Thank you so much, Brian. It's always a pleasure.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.